On the agenda tonight, the market made it clear this week it doesn't want rate cuts. Will the crybabies finally listen?
Hey, this economy is getting through these interest rates. And then I became, much more bullish on what the economy is going to do and backed off from any recession probability. Yeah, I was definitely that way a year ago, but I pivoted last summer, and I still see that strength despite the interest rates that the Fed has had. You know, this may surprise people. I'm calling for a 75 basis point emergency cut in the Fed funds rate with another 75 basis point cut indicated for next month at the September meeting. And that's minimum.
In a week that witnessed the third largest explosion in the volatility index, most traders lost and the market maker, aka the dealer, won.
Sure, but send you in here to rob me now. Been knocking everybody's dick in all night. Huh? You've been beating all the customers tonight, motherfucker.
And with the market closing the week flat all in all, the experts say that calls for fear are unfounded.
Now's not the time for fear. That comes later.
All right. Today is Sunday, the 11th of August. This is a recap for the stock market activities for the week that was and an outlook for the week to come. And folks, I got a good one for you tonight. Before we even began to digest last weekend's video, the markets were already on a roll. The action was already going on. Overnight, we've seen a crash in the Japanese index because of the unwinding of the Japanese yen short trade, the biggest crash since 1987. And even after a recovery midweek, the damage is already done on Japanese stocks. We have seen one of the sharpest collapse in valuations in history. And we don't see these kind of things except in crashes. Right off the gate, as the Japanese indices were going down, we have seen a $1 trillion wipeout in mega cap stocks. And the two trades are related, folks. We'll talk about that in a minute, but if you're shorting the yen and you're long technology stocks, well, if the yen rallies, you got a margin call in your short yen, you got to free up some capital by dumping your mega cap stocks. It works that way. And the question now becomes, of course, are we finished with this Japanese yen margin call trade? And the answer is, hold your horses. We'll talk about that in a minute. But spoiler alert, not really. We've even seen a big hit in crypto markets with billions of dollars wiped out, and crypto bulls lost $200 million in a single day. The VIX, aka the volatility index, surged to the third highest reading of all time. Some would say the dumbest explosion in volatility that we've ever seen, but others argue that it is a sign for more to come. Now, of course, you got the crybabies like Larry Summers who came out and said, oh, the SEC needs to investigate the surge in the VIX that happened on Monday. But funny how Larry Summers never called the SEC to investigate why the VIX is so suppressed when we have a lot of risks to worry about. And I got news for Larry Summers. The SEC is in a coma, and their job is to facilitate the filth and the theft that happens every single day in Wall Street, where the big shots get to manipulate the market and get away with it. The job of the SEC is to cover for that, not to investigate it. And I'm pretty sure somebody made big bucks from the explosion in the VIX last Monday. But let's be honest here, folks. Before the explosion in the VIX on Monday, before we've seen the unwinding of the Japanese yen trade, over the weekend, we're talking about last weekend now, there were a lot of fears that maybe we have recession signals, maybe we have sentiment indicators pointing out that the end is near. For example, you got Warren Buffett, the greatest investor of all time, dumping 50% of his shares in Apple. Well, that gotta say something about the health of the market and the state of the economy right now. With or without the Japanese yen trade, we were destined for an ugly opening this week. But folks, the fact that Warren Buffett sold 50% of his shares in Apple. That solidifies that Warren Buffett is the greatest investor of all time. It was baffling to me, and I tweeted this last year. Berkshire Hathaway is committing the biggest mistake in its history by not addressing the swelled concentration of its assets in Apple. Don't put all of your eggs in one basket. That's what Warren Buffett said. It was baffling to me. Why would he let the Apple position go crazy? Over 50% of Berkshire Hathaway's concentration. That doesn't make sense at all, because when the mega caps go down, they will take the indices down too. And if Berkshire Hathaway is 50% in Apple, they're not going to withstand this market turn down, as they did, by the way, in the previous ones. Berkshire Hathaway always been a recession-proof, crash-proof, because Warren Buffett's seeing things ahead of time. And now we got the answer. He does see it, and he fixed it. But rest assured, folks, the retail investors say that, remember what Warren Buffett said, brah? He said, be greedy when everybody's fearful. So we're going to buy the dip right away. The guy who made that quote was actually dumping stocks. So maybe there is no actual fear in the market. Maybe we have excess euphoria, and that's why he's being fearful when others are greedy. And while retail investors bought the dip, along with, of course, famous investor Mama Cathie Wood, $59 million, she bought the dip. And of course, we continue to follow the mystery of how the does Cathie Wood finds millions of dollars to buy stocks at this point. I wish I can find millions of dollars laying around under the mattress to buy stocks when my investment strategy been a shitty one and we lost already billions and billions of dollars to investors. But again, folks, while the retail investors and Mama Cathie Wood bought the dip, wealthy investors, this headline is kind of deceiving by CNBC, but this is nothing new. It reads, wealthy investors find opportunities in stock market sell-offs. Oh wow, it seems that the retail investors, Mama Cathie Wood, and even wealthy investors, sophisticated investors, are all on the same page. They're buying the dip, they're finding an opportunity in the sell-off. Maybe Warren Buffett is being a baby right now. But then you read the article and here it is. Private banks and wealth managers say their clients have been reducing their stock holdings for over a year as a part of broader shift from public to private markets in light of recent concerns about overheated tech sector. Whoops. So the rich, the insiders are getting out and the poor is getting in. But folks, from a trading perspective, this week was trappy from the get-go. And you had to be really, really careful because we open with crash headlines, lots of fears with the VIX exploding above 60. And we see, you're looking right now at the chart of the SPX, the S&P 500 cash index. And you see Monday's candle, that was a gap below the lower Bollinger Bands, something we haven't seen even during actual crashes. And when that happens, you got to understand a lot of you trade options. And in a nutshell, trading options comes down to the probability of something happening by an X period of time. Now think about it this way. When we open gapping down on Monday, below the lower Bollinger Bands with a VIX at over 60, what was the probability of a crash? Highly likely. There was a lot of fear, which means the nature of psychology traps will get you in to say, oh my God, I missed out on the recent flush. I've been waiting and waiting for a rebound. Appears there is no rebound to short. I'm shorting right now. The problem is you're not thinking about what about the market maker? What about the dealer who's actually writing and selling these options? What do they see from their perspective? Of course, they see the same thing. They see that the probability of a crash is now highly likely. So what they do is overprice the options, puts and calls, by the way, because when there's a possibility of a crash or oversold conditions, there is also the possibility of big rebounds. So they overprice the options across the board, meaning that the likelihood of you entering a trade at that point, you're going to end up overpaying for the trade. And when you overpay, the probability of success is less likely, even if the trade goes your way. The opportunity was when nobody was really anticipating that we're going to have a crash or a pullback. That was the opportunity to enter these trades. And by the way, we spotted them step by step, day by day in this program. But a lot of folks were skeptical. Not going to happen. They're going to move the market higher again. Maverick, forget about it. Okay, now you want to get in when it's already overpriced? Guess what happens? And this is what we said, folks, in my Discord Monday right away. I'm in the camp on rebound plays have the better odds right now. I have not seen the SPY goes below the Bollinger Bands and keep going down without any rebound. Not even during actual crashes. Could be different this time, though. In response to another viewer, I said we have never seen Bollinger Bands violation like this, even during the crashes of 2000 and 2008. But I can tell you for sure right now, the downside risk is very limited in the short term. The upside/rebound risk carries the better odds in the short term, after conditions correct. the downside risk resumes because breaks like this indicate more pain to come in the longer-term charts, meaning the weekly charts. A lot of folks wanted to short Apple right away because Warren Buffett dumped. We said the same thing. I say hold your horses a bit more just because it is oversold at the lower Bollinger Bands right now. I don't like to open shorts here. I agree, it'll be below 200, but I don't think we have a good entry here. Folks, the entry matters, long or short. And this week, it appeared that the market maker was about to lose. They don't like to lose. So when we go back to the chart, Monday, bear trap right off the gate. A lot of folks going to overpay. Even if the market goes down, they're going to lose money either way because of the implied volatility concept. Those who bet for a rebound, well, it played out good Tuesday, then comes Wednesday. And we hit the 100 days moving average in red, and boom, we get a flush down. Of course, everybody who bought calls is now scared, and they get out of the trade at a loss. Well, guess what happened the day after? We go higher again, and we close the week above the 100 days moving average. This is how the dealer, aka the market maker, slaughtered both the bulls and the bears, and they walked out being the winner of the week. Now, what is the psychology at this point? I mean, listen to this headline right here. What market crash? ? The S&P 500 closes almost exactly where it was a week ago. Right now, we closed above the 100 days moving average. Everybody says, look, it was a scare. Now it's gone. Let's hop in and buy some stocks or buy some call options. Next thing you know, the fear is going to come back in and the market maker is going to slaughter everybody else again. And at this time, think about the psychology of those who shorted Monday and ate a massive pie in the face. Are they going to short right now? Not really. They're too scared. They're going to say, oh, it's just going to rebound again. Forget about it. Next thing you know, the market turns around and goes down, retesting the lows, even breaking the lows. What I'm trying to say here, be careful of the psychology pitfalls and stick to the facts and the indicators. Where do we find the facts and the indicators? Let's begin with the wall of hope. Folks, we know that in the wall of hope, we at least had rate cut optimism. Now that changed. Now the wall of hope actually has no rate cut optimism. We don't want the rate cuts anymore. We've been jerking off for about a year based on the prospect of, oh, the Fed is going to cut rates and now valuations can go crazy again and you got to buy in anticipation of that happening. But anybody with experience knows that rate cuts in a cycle like this, they don't happen for the right reasons. They happen for the wrong reasons. And be careful what you wish for. The moment you get rate cuts, that's when things turn ugly. And that was proven in the last couple of weeks, that every time we've seen any prospect of bad news, meaning recession news, we used to dub as good news for the market before, because that's going to accelerate and bring the rate cuts faster by the Federal Reserve. Hence, the mentality of the market was good news equals bad news, and bad news equals good news. Now the mantra changed in the last couple of weeks, and it's an important change. If there was one take that you have to understand from the last couple of weeks, we're now in the mantra of good news equals good news, bad news equals bad news. In other words, the market doesn't want rate cuts, because if we have rate cuts, it's a proof that the economy is heading into a recession. And the market right now doesn't want a recession. The market actually right now wants good news. That no, the economy is doing pretty good right now. There is no recession fear at all. Well, guess what we got this week? And I predicted this, by the way, in last weekend's video. I said the manufacturing PMI, or ISM, gave us a recession fear, and that's warranted because manufacturing is in a recession. The trucking industry in a recession. A lot of small businesses in a recession. A lot of sectors of the economy and the consumer are in a recession. We have the icy hot phenomenon in the economy. Some sectors in a recession, some are not. Still hot, still inflationary. And we explained this in the program for a long time. But this week, Monday, what accelerated the rebound and the buying that we've seen in the equities market was the fact that we got a good reading in the services ISM. It shows actually expansion in the services sector of the economy with a little bit of inflation, but not much. Right off the gate, good news is good news. And we've seen a recovery not just in equities, folks, but a recovery in the dollar and bond yields, something we used to fear just a couple of weeks ago because it indicated that rate cuts are not happening anytime soon. Now, all of a sudden, we don't want the rate cuts. Then we got again, a lot of folks said this is a fake or a cooked piece of data. It doesn't really matter. It did the job in saving the market. We got the news, this was on Thursday, that weekly jobless claims fell to 233,000. That was less than expectations. So again, good news? Yes, it is. So we're going to rally upon good news, even though the day before the market looked like it was about to break. So again, folks, we stick to the facts and the indicators throughout the week. I've been giving my viewers these indicators. If they're pointing at to bullish, you stick with that side. When they point out to bearish, you go with that side. Thursday's session, this was the look. All of them were pointing at bullish. So let's look at them right now. What do they show for next week? We begin with the Japanese yen, US dollar. We want to see the Japanese yen going down, not up, versus the dollar. We don't care if that's happening because the Japanese yen is actually going down or because the US dollar is strengthening. So long as the yen goes down against the dollar, the risk of margin calls is diminished. And right now, when we look at this ratio, I gave you the confirmation line, bullish or bearish. Above, bearish for the market. Below, bullish for the market. Well, now below, and we're forming a pattern of lower highs and lower lows. So long as we keep that, and there is no spike in the Japanese yen versus the US dollar, then the risk of margin calls is not here. The moment we see the yen rallying again, that's when the risk resumes, because everybody who's short the yen will have to dump their technology stocks to cover for that short. So for now, it remains bullish. The next indicator was the 2-year yield versus the 10-year. And every time we see a tick higher, good for the market. Every time we see a tick down, bad for the market. And I can prove it to you by plugging the NDX, the NASDAQ chart. You can see the correlation right here. Every time we tick higher in the 2 versus 10, market goes in a rebound. Every time we go down, we see the market flushing down. What are the implications from this? Well, when the 2 to 10 ratio goes higher, it means that the 2-year yield is outperforming the 10-year yield. Translation, Maverick. It means, once again, if you understand that the Federal Reserve has more control over the shorter end of the yield curve, meaning 1 to 2 to 3, but it has less control over the longer end of the yield curve, the 10 to the 30. Okay, if bond yields on the 2-year yield are outperforming bond yields on the 10-year yield, what does that mean? Less likelihood of a Federal Reserve rate cut, and the market is rallying based upon that. So once again, the market is screaming out loud. We don't want the rate cuts right now, because if we have them, it means that there is panic about the economy, that the recession is real. And recession is not good for the stock market. Never was and never will be. So right now, based on the close that we got on Friday in the 2 to 10 year, we're still on the bullish side because we have a tick higher. How about the dollar? You got the US dollar in candlesticks, and then you got the NASDAQ futures in white. We could see that usually when we were anticipating rate cuts, when we were afraid about, oh my God, maybe the Fed is not going to cut rates or, God forbid, raise them higher. Every time the dollar went higher, equities went down. That was the mantra, because if the Fed is not cutting rates, then it's not loosening the monetary policy, which means it's not increasing the supply of the dollar. So the dollar firms up, and that's bad for equities. Notice the change that we got recently. Both of them are trading together. The dollar in candlesticks and the NASDAQ in white. Why? Because right now, the market is actually saying we don't want the rate cuts. We don't want to increase the supply of the dollar. We want the dollar to go higher, because if the dollar goes higher, it means no rate cuts, and it means that the economy is actually doing better. And that's what we want to hear right now. So we look at the dollar. It rebounded. Does it look good as a sustainable rebound? No, not really, which suggests that we're probably going to go down in the market again. But for now, for the close that we got Friday, bullish, but beginning to move toward the bearish side for the market. We look at the 10-year yield. It's the same thing. During the mantra of good news equals bad news and bad news equals good news. Good news, if the economy is doing better than expectations, then there is no need for rate cuts. And we see bond yields going higher and the market going down. That was the mantra before just a couple of weeks ago. Now we have bond yields on the 10 and the NASDAQ that you see in white right here trading together. They go down together, they go up together. Once again, proving that the market no longer is seeking rate cuts, and the market is actually afraid of them, because every time we see bond yields going down with expectations of rate cuts, the market reads that as, oh my God, recession is coming. Every time we see a tick higher in bond yields, the market reads it as, okay, maybe we're overreacting to recession and the economy may be doing better than expectations. So right now, based on the close that we got Friday, we're still in a rebound, but it appears that maybe we're forming somewhat of a bearish engulfing candle in the 10-year yield. So bullish, but moving toward bearish. These are the leading indicators you need to look at. The last indicator that we got is the VIX, and I gave my viewers this. Above 30, we're bearish. In the market, of course. Below 30, we're bullish. By the way, bullish means that the rebound risk has better odds than the drop risk. But now we're at 20, and I think that's the point where we're going to find some support. We'll see. Of course, the proof will be if we pass 30 again, then we're going to shift back to, okay, we have volatility. It's probably coming because of the Japanese yen going higher again and folks dumping their technology stocks, leading the VIX to go higher above 30. And if we see that, it's going to be more of a proof that, yes, we have a bearish signal now. But as of the close of Friday, below 30, close to 20, so the VIX remains a bullish indicator for the market. With that understanding out of the way, folks, I just proved to you that the market doesn't want rate cuts. That the biggest fear for the market right now is rate cuts. So why do we have the so-called expert economists coming on TV? The expert hedge fund managers, the experts on CNBC coming out and saying that we need rate cuts right now. Why? When the market is saying, I don't want it. That's the proof right away, folks, that economics is a bullshit voodoo science. I mean, the fact that some of these guys are economists is absolutely absurd. So don't feel bad if you got an F in economics in college, because you actually got F in bullshitting, which is a good thing. Anyhow, I'm not bad-mouthing the economist right here, by the way, because he's right. The top economist, Mohamed El-Arian, he said the Fed would make a huge mistake if it lets itself to be bullied into cutting rates. And this is a message to the good professor from Warren, Jeremy Siegel, who's been wrong on everything pretty much. Not just this time around, but going back all the way to the dot-com bubble. But again, economics, it's the art of bullshitting, and you can bullshit your way into having a job. Anyhow, this is what Mohamed El-Arian says. I strongly oppose this notion of an intermittent cut. That would be a huge mistake, he told Fortune in a phone interview. I think it is a little bit like wanting to go to the emergency room for a cough. And I say, amen. What is the emergency here? Oh, the stock market went down because we have margin calls in the end trade? Well, I mean, what's going on here? But the perma pumpers, like the fake economists, like, Good Professor and others that we can mention here, it gives you a sneak peek of how they're going to react when the actual beginning of the tragedy happens. They will be calling for a 200 basis points rate cut right off the gate. Never called for that when we were hiking rates. Even though it could have done the job earlier, and now we'll be cutting rates with no problems in the economy at all. Still, Warren professor Jeremy Siegel was quick to call for an emergency rate cut as stocks tumbled Monday morning. The veteran stock watcher, really? Anyhow, argued that the economy is slowing and inflation is essentially defeated, really? Meaning that the Federal Reserve is behind the curve once again. See, this notion of inflation is essentially defeated will be tested this week via the PPI and CPI. Now, recession fears are legitimate, but everybody right now is ignoring the inflation risk. Here's what could happen. This week, if we get the CPI and it shows sticky inflation, it'll cause a disaster in financial markets because the recession data will keep pouring in. But sticky inflation, or even worse, hotter than expected CPI, will handicap the Fed's ability to cut rates and mitigate the recession risk. And that's when we all realize that it's game over. Stagflation means the end. So that's what's going on with the wall of hope. It's no longer the rate cuts optimism, it's the no rate cuts optimism. What about the AI mania optimism? That's still alive to a certain degree, even though you look at NVIDIA, for example, it took out about $1 trillion worth of valuation. Why would that happen when we have still revenues in AI are growing pretty good? At least from the earnings reports that we got. It's because the market looks forward. And the market was pumping these stocks higher in expectations of the explosion in revenues and net income. Now the market sniffs that we're seeing a stall, a peak in the growth rate in revenues and net income for a simple reason we call the law of large numbers. That year on year, you're facing huge numbers from last year, and you can't beat them as easily as the numbers from last year versus 22. Which means, at least on paper, we'll see the growth slowing down. Now, you sprinkle on top of that recession fears, and now the market sniffs a worse outcome, not just a slowdown in the growth, but perhaps a collapse in the growth. And that's why we see these AI stocks going down, despite the fact that at least looking back in the rear-view mirror for the quarter that was, the growth is still intact. Well, I'll give you an example here. We got the stock of Supermicro, the ticker SMCI, which reminds me a lot with the 1990s dot-com bubble. And I said that this is going to be the first name that's going to crash, and then we will see the big AI names following. So Supermicro is the early warning sign about the AI bubble. And the stock went down big this week. Why? Because the sequential profit growth was actually down 12.35%. The numbers were phenomenal, whether you look at the top line or the bottom line. But then you look at the growth rate, it slowed down dramatically, and the market has the nature of sniffing that ahead of time. On the other hand, we had another stock, Lumen Technologies, the ticker LUMN, and by the way, we covered an unusual trade on it about a week or so ago. And now we know why. Somebody was trading based on insider information, and now we know why the stock of Lumen exploded higher this week based on AI optimism. So again, we cannot argue that the AI mania has been completely eliminated. So that remains a bit active in the wall of hope. What about the wall of worry, though? Because right now, the market seems to be more in tune with the wall of worry than the wall of hope. We have few items: the policy risk, the election risk, geopolitical risk, China risk, the monetary policy risk, and of course, the Bank of Japan risk. Let's begin with the policy risk. Do we have anything active right now? Of course, taxation will become more important as we get closer to November, but right now, the policy risk that is looming large in the market is the fact that we have the restrictions on chips to China. And that could derail, if not eliminate, the last element of hope that we have in the wall of hope, which is the AI mania. So we're going to continue to follow what happens with the restrictions, but the market will sniff it ahead of time. If the market sees, wait a minute, the restrictions for AI chips in China will hammer NVIDIA's earnings in the quarters to come, it will begin to sell NVIDIA ahead of time. Then when we talk about the election risk, and we have to replace Joey B here because he's no longer relevant, but we know that there is an election risk when it comes to China too. Because if Trump gets elected, then we're probably going to have more and more tariffs. A, that's inflationary. B, it could hammer the economy in China even more than it is right now. And we know that a lot of U.S. companies depend on growth in China. So we're going to see the market beginning to price that in. And of course, when it comes to the Kamala Harris side, the risk is corporate taxation. If we have the corporate tax rate going higher, that's going to be bad for corporations and bad for the stock market because it reduces the margins of these companies. Now, when it comes to the elections right now, who has the upper hand? After the assassination attempt, we've said that the elections is in the bag right now, that the Republicans will win. Well, it seems that changed rapidly. And now we see Kamala Harris has the better odds of becoming president if the elections were to be held today. As you can see in the polls, she's taken over Trump. Now the odds suggest that Harris will be president. And of course, the market doesn't like it, at least right now. As you can see, the market's downturn accelerated once we've seen Kamala taking the lead in the polls. And in my opinion, why do we see the Democrats taking over the Republicans in the polls? A lot of you will be skeptical that these are fake numbers or whatever, but I'm going to call you out here, maybe knock some sense of reality into you. Because yes, I believe that the Republicans are losing and the Democrats are winning. Why? Because the Republicans, once again, not surprising of course, fell into the trap that the Democrats set up for them once again. The abortion trap, which worked out in the midterms, by the way. It's supposed to be a red wave, turns out to be not. And the Republicans never failed to fall into this trap over and over and over again, instead of talking about the economy. Once the Republicans talk about the economy, they'll take the lead in the polls, so long as the narrative is shaped and dominated by the abortion issue, the Republicans will lose. But anyhow, this is your election risk for now, not flaring up a lot, but worthy of noting. Now, when we talk about the geopolitical risk, that could happen at any moment right now. By the time we have the video out, we might see something happening. On one hand, we have a flare-up on the Russia-Ukraine front, with the latest incursion by the Ukrainian forces within Russian territory. That's going to prompt a response by Russia, and it could be an aggressive response that could bring back what we've seen in 22, the rise in commodities pricing. And the Russians are not stupid. They know that we have an election season coming really soon, and they want to add maximum damage. So they could do something that could flare up commodities and increase the inflation risk heading into the elections. Of course, when it comes to the war itself, I predicted this long time ago. We're going to keep egging the Ukrainians and giving them more and more weapons, and they're going to start testing more and more red lines. And at some point, they'll do something really crazy within Russia that kills a lot of civilians, and Russia will finally respond by deploying a nuclear weapon within Ukraine. And then the gloves are off and the world is going to change. But the Russia-Ukraine front is not the only one that's active right now. We have the Middle East. We got the exclusive report by the Journal that suggests that Iran is getting closer and closer to developing a nuclear weapon. Not surprising to me, because you need balance in the Middle East, and the Iranians will look at the recent Israeli aggression against them as, okay, we have no other choice here but to develop nuclear weapons, because then the game becomes more balanced. Everybody knows that the risks are too high, and maybe that's going to lead to a peaceful resolution, even if it is fragile. In the meantime, we know that there is a retaliation strike coming by Iran against Israel. Whether that's going to come from Iran alone or includes Hezbollah and Yemen too, who knows? But the U.S. forces are there too, warning Iran of serious risk if it conducts a major attack on Israel. Meaning the message: if you're going to do something, do it small and fast. If you do something big, the war begins. And if there is a war in the Middle East, folks, what do you think will happen to the price of oil? With the closures of the strait and all of the disruption that could happen to the flow of oil, that's going to bring the inflation risk back on the table again. We have Super Hornet fighter jets loaded with supersonic missiles spotted in the Middle East. So something big is brewing right now, and it could escalate in a major war. And of course, your beloved treasonous politicians sent another $3.5 billion to Israel, a rich country that doesn't need really the help. They can pay for the weapons themselves, but this is the money laundering campaign. We give them $3.5 billion. They send it back to the weapons manufacturers, buy more weapons, and cause more disruptions and volatility in the Middle East with them. Now, can I do anything about this? I can't. I can call out the politicians, but at the end of the day, my money's gone. They sent it to Israel. How can I get my money back, or at least a portion of it? Well, that's why I'm an investor in Lockheed Martin, and I've been an investor in the company for a long time. I've been telling you folks, you gotta have this criminal portfolio in your lungs. You gotta invest in the defense contractors, the big pharmaceutical names, and now more than ever, the criminal/money laundering portfolio is the best portfolio to have, because these companies also happen to be dividend-paying stocks, and that's what the market likes at this stage. So you look at Lockheed Martin. Now, would I suggest that somebody buys the stock for the first time at this massive pop right here? Not really, but who knows? If we have an escalation in the Middle East, it might go higher. You look at Raytheon, RTX, another stock that we own in the portfolio. It looks that it was toppy. Maybe not a good point to enter, but then Friday closed above 115.82, confirming a bull flag breakout, not a topping in his shoulder. Now, can we turn around again? Or we take 115.82 and we actually play the head and shoulder? Sure. If the Iranian response is a nothing burger, if we have a peace deal magically, sure. But the odds right now say that these stocks are probably heading higher. We also have an actual economic impact on U.S. corporations from the war in the Middle East. You guys heard what happened with McDonald's earnings, Starbucks earnings, and this week we got Yum Brands. So you got McDonald's and Starbucks. They talked about it a little bit, but they didn't stress that as a factor in why their earnings were shitty. Even though in this program, when we did the earnings reviews for both McDonald's and Starbucks, I proved to you, looking at the data, that the Middle East boycotts, and by the way, not just happening in the Middle East, happening in Asia, in Europe, in North America. These boycotts are having a major impact on these companies. And the latest, of course, being Yum Brands. All of a sudden, we have boycotts against KFC and Pizza Hut, and that is leaving a major negative impact on these companies. What about the China risk, though? Of course, the Taiwan issue is always on mind, but right now, the most immediate risk from China is the data that we got this week, the import versus export. So we've seen exports going down, but imports going higher. Now, somebody might read this as, okay, the obvious one, exports going down. That's bad for the global economy. It is an indicator that demand from the global economy on products coming from China, which is the majority of products, is slowing down. Demand in the USA, demand in Europe, demand in the rest of Asia, slowing down, and this is why we see Chinese exports going down. That's the easy one to explain. Why do we see imports going higher? Is it because the Chinese economy is strengthening? Not really. We got warnings from multinational companies saying they're actually sounding the alarm over weak demand in China. We got the data of China's commodities imports, not looking good. The lowest imports of crude oil since the year 22. So how do we read the increase in imports by China? We just talked about it. We have the tariffs, which the Biden administration now extended. They're not going to do them right now. They'll do them later. They extended the deadline. And we also have the chip restrictions coming out. So the Chinese are accelerating buying U.S. products and buying chip products before the restrictions kick in. Now, that could be a catalyst for some of the AI companies, that we see acceleration of demand by China based on fear about the restrictions and the tariffs. But again, the market will look forward, folks. The market sees the restrictions as what's worthy of concentration right now, not the fact that we have acceleration of demand by China before the restrictions kick in. Now, perhaps the most important element of the wall of worry that's going to be active this week is, you see that Jerome Powell with the no deal thing? That's going to be the most immediate concern for the market this week. Now, you might say, but Maverick, there's a contradiction here. You said that no rate cuts is actually an element in the wall of hope. It's a good thing for the market. Why is it bad now? I'll tell you why. Because the market is going to throw a fit either way. You see, the flow of recession news is not going to stop. Sure, we got a good reading in the services ISM, we got a good reading in jobless claims, and that kind of mitigated the recession fears for a while. And the market took a sigh of relief that we're not in a recession and rate cuts are not going to happen. But soon enough, what we got from McDonald's, what we got from Disney, what we got from many consumer companies, that consumer spending is slowing down dramatically. That kind of recession news will hit the market again. And the market at some point would say, okay, give me the rate cuts because that's the last hope. What if the Fed can't give the rate cuts either way because we have the recession risk coming back in because of geopolitical reasons or lack thereof? You see, when we talk about the recession risk, take for example Stellantis laying off 2,450 employees this week alone. We got Cisco announcing layoffs of thousands of workers. And this is the second cut this year alone. We got the news from Paramount laying off 15% of the US workforce. We got news from Intel laying off 15,000 employees. And here in the city of Las Vegas, leading indicator, we're beginning to see layoffs in the casinos. This flow of bad news is not going to stop. We've explained why in details in this channel. When you look at the reports by Disney, McDonald's, Starbucks, pretty much every consumer company. Revenue is stalling because the consumer is not spending. Okay, maybe they're going to cut pricing and hope that that's going to increase the volume. Not working so far. Skeptical that's going to work. Can they control the cost of the goods that they sell? No. So the only way to improve margins is to cut the headcount. So the unemployment rate will move higher, more and more bad news will come in, and the market at some point will say, hey, give me the rate cuts. I need them now because it appears that the economy is already in a recession. What if the CPI this week comes out hot? And the expectations are that it's going to come out positive. It was negative in the last reading. It's going to come out positive. How positive, though? Is it going to beat expectations by a lot? And if it does, even if the economy is in a recession, the Fed's ability to cut rates will be handicapped. And that's the worst outcome, because it is stagflation. So be careful here. This week, if we get a hotter inflation reading, it could be game over for the equities market. What about the yen risk in the Bank of Japan? We know that the carry trade crashed global markets, but then the yen came down in the remainder of the week, cooling off the risk of margin calls. And so far, so good for now. But you got to understand that the short position against the yen is still elevated. So JP Morgan says that maybe we're 60 to 70% done with the short covering in the yen. I think there is a little more. In the last 30 to 20%, those are the most aggressive. So I don't think we're out of the wood yet. I think we have more short covering coming for the yen, which means more sell-off in technology stocks to finance the covering of those shorts. Of course, they can find out a way where the funds that are shorting the yen can borrow money from the Fed or from other banks instead of selling their technology stocks to keep the equities market elevated. But I think that's a far-fetched idea right now, unless we see more and more damage by the unwinding of this yen carry-on trade. Anyhow, folks, let's add more color to this conversation because we're not done yet. And let's segue to covering the market activities, beginning with the closing of the indices on Friday. And here we go. The Dow closing the day on Friday up 51.05 points or a gain of 0.13%. And the Nasdaq also in the green by 85.28 points or a gain of 0.51%. The Spider closing positive by 24.85 points or a gain of 0.47%. The laggard for the day, the Russell 2000, actually in the red, down by 0.43 points or a loss of 0.21%. A lot of folks believe that the Russell 2000 is the leading indicator, and it's maybe leading that the equity market will begin to trade down as we open a new week. Look at the daily performance for sectors. Everything is in the green on Friday. I think a lot of it was algorithmic. The indicators that I gave you were pointing out for the algos to buy, and therefore we've seen pretty much every sector on Friday closing positive. Industrials down a tick, but again, we're not going to make a big deal out of it. Contrasting this with the weekly performance, what do we see here? Believe it or not, energy was a number one. The price of oil actually exceeded the gains in the rebound in the equities market, which added up to flat. But oil managed to eke a gain for the week. And this is why we see energy stocks coming up number one. Technology with the rebound. Of course, we've seen the majority of the damage happening overnight before Monday's opening. And then after that, we've seen the dip buying happening mostly in the technology stocks. Financials are number three. But the laggards, we have metals. Why are metals lagging? Perhaps the rebound in the dollar, the rebound in bond yields. You combine that with recession risk that maybe metals are still worried about than the rest of the market. And this is why we see metals at the bottom of the pack. Utilities also in the red along with defensives, dividend-paying names in the risk-off category. They appreciate when bond yields go down for the wrong reasons. Well, this week, bond yields rebounded and went higher based on the ISM services data that we got and the jobless claims. So there was a rotation out of utilities and risk off into risk on and technology, but it was higher quality kind of risk on. The mega cap companies, the chip companies, not the shitty quality risk on in the small caps and the IWM. And by the way, we have predicted all of that on Twitter before it happened. Friday's session before the crash, I said, look, we're going to see a rotation out of utilities and the dividend risk off kind of rotation back into high quality risk on. And you see it right here. Looking at the breadth on Friday, the NYSE 49% advancing versus 48% declining. The NASDAQ 39% advancing versus 58% declining. So the NASDAQ bad breadth despite the positive close. Implications, the majority of the gains in the NASDAQ happened by those higher quality mega cap technology stocks, but the rest of the NASDAQ was actually getting brutalized. Looking at the heat map on Friday, we see the majority of stocks going higher, led by what's been damaged. So you look at the big cap technology companies, Amazon, Meta, Google, Apple, Microsoft. You look at the chips, Taiwan, AVGO were higher, although Nvidia still the weakest card because that's where the money is coming out of. If you want to cover for margin calls, if you want to cover for rotations, if you want to free up capital to buy gold or buy bonds or buy whatever you want to buy, Nvidia is the biggest cash cow right now. But we see even the Ozempic mania caught a bid on Friday. So we see the majority of the market went higher based on the algorithmic reactions of the Japanese yen going down, etc., but the majority of the gains were concentrated on the laggards, the names that got hit recently, the manias, be it in the multiple expansion in the big caps, or the chip mania, or the Ozempic mania. If we contrast the heat map with the weekly heat map, what do we see here? Of course, earnings will push things up and down. So you see, for example, Caterpillar went higher for the week, but then you see another industrial giant in the red. You see that red block right there, that's Emerson. That went down for the week. You see the contrast in chips. So you have names like Taiwan, TSM was higher for the week, but then you have names like Supermicro dragging Dell with it, of course, to the downside. But needless to say, the big caps for the week still closing negative, Nvidia negative, Tesla negative, a lot of names went negative, the majority of the stocks went negative, but we see sizable gains for others based on earnings, as we talked about in Uber and Trade Desk, in Fortinet and cybersecurity, which also helped Palo Alto and CrowdStrike to rebound. But Meta is the interesting case because when folks wanted to buy the dip this week, if you had to pick one mega cap technology stocks, which earnings were the best? Was it Amazon, Google, Apple, Microsoft? No, it was Meta. That's the company that was producing a good number in the growth in the top line and the bottom line. There are concerns, of course, about Meta if we have a slowdown in advertising spending. But for now, it is the best of breed when it came to earnings, and this is why it was the number one stock that benefited from the rebound this week in the mega cap stocks. You see some of the risk-off dividend rotations losing a bit of ground this week, like PepsiCo, like Coca-Cola and the staples. You see them in utilities down for the week. You see names in healthcare, high dividend-paying names like Pfizer, like Amgen, like United Health, all down for the week. Looking at the heat map for the week, this time around for the ETFs though, the TLT is down, so we know that bond yields are higher. Usually bad for the market, but not after we get the good news is good news, bad news is bad news mantra. Now, when we see bonds going down, yields going higher, that's good news. All in all, though, it didn't help the market by a lot. We have certain sectors that went higher, such as energy, XLE, XOP, industrials, XLI, the financials, XLF, the chips, mostly because of Taiwan during Friday's pop, SMH and SOXS, but the rest of the market was down to flat. The notable gainer was the EWZ Brazil. This is plain commodities, it's on news, but when we see oil going higher, generally it's good for EWZ. Speaking of, moving on to commodities, on Friday we see rebounds in WTI worth about 1%, natural gas beginning to show some ground here, moving by a little over 1.5% on Friday. But then we have Brent as laggard, RBOB, heating oil in the red. Looking at softs, cocoa, massive gains on Friday, over 10.5%, cotton, with gains of almost 2%, and lumber, with gains of almost 4.5%. The laggards, OJ and coffee, down a little over 4% apiece. We'll talk about coffee in a minute here when we look at the weekly performances, but mixed action when it comes to metals, gold up, Gold still showing the best resiliency against what's been going on in the market so far. Copper up on Friday, but you cannot really trust it. Silver is not as reliable as gold. I'll show you that and prove it to you in a minute when we look at the charts analysis. But we see meats up for the session and then grains. We got mixed picture on Friday, but keep an eye on this Russia-Ukraine tensions. It could revive at least the wheat, if not the oil trades, because you got to remember sunflower oil coming out of Ukraine, more disruption to that. It'll be the gains of soybean oil and canola. Looking at the weekly performances for commodities or futures, cocoa at number one, massive gain on Friday, took it to the lead. But nat gas was a great comeback this week, up about 10%. In energy, folks, WTI up almost 5%, Brent up a little over 3%, outperforming the gains that you see in the SPY or the SPX, the NASDAQ. Then we got commodities like coffee and sugar doing pretty good for the week, even though coffee declined on Friday, but remember that we got a trade on it before the week even began, Monday. If you're looking at the chart right now, coffee actually went down, retesting the lower Bollinger Bands on the daily chart. And every time we've seen that, we got a rebound. So if you didn't catch it Friday, Monday was a great buying opportunity. We went all the way in a pop to the upper Bollinger Bands. That's when we took profits. On Friday, we see a big whack to the downside. Maybe we'll see coffee coming back again, but this is how you trade commodities. Lots of gains if you're just following the charts. The next one I'm eyeing here would be sugar. So if we look at the weekly chart for sugar, maybe double bottom. Maybe we'll see this bullish momentum that began in the MACD accelerating, but we need to see a little more. But it is a trade that I'm eyeing. We'll see what happens. Moving on to the big casino options, what do we see here? Believe it or not, the volume throughout the week wasn't really good in the options market. It means that the retail investors that bought the dip bought shares, not options. The fact is, options traders were shy away from the market this week, and for good reasons, because the pricing was not good. Only the amateurs who fell into options trading this week, it wasn't really worth it because all of the IV ranks exploded higher and then they came down, as you can see on Friday. We're now seeing really good reads on the IV rank. Nvidia's down to 65, 66, Tesla at 40, Apple at 45, even AMD at 50 now. It was 100 just a couple of weeks ago. So the pricing is getting a little more attractive, which means if you believe that we're going to head down again for whatever reason, technical reason, fundamental reason, yen reason, doesn't matter. The options right now, the put options at least, a lot cheaper than they were Monday. The question is, are you going to enter these puts or not? Or are you too scared by the rebound? Likewise, if you feel that we're going to rebound and the worst is behind us, but maybe you're waiting for a pullback to get in, well, understand that the IV ranks are pretty good right now, so I don't know if you're going to get a better price than right now. The question is, are you going to hop in and buy the call options betting for a continuation of the rebound, or are you too scared that we could fail and come down? Options trading, you gotta have balls, you gotta have brains. Otherwise, it doesn't work out. Let's do the bullish versus bearish flows on the buy side. Buying calls on Eli Lilly and gold futures on the VIX, whoops, the SMH, the semiconductor ETF, Reddit, LNG Cheniere, EA, Electronic Arts. They're buying puts on the futures, on the indices. That's hedging, it happens all the time. But they're buying puts on Meta, they're buying puts on Monday.com, bought puts on Nvidia. When it comes to the bullish versus bearish flow on the sell side, they closed puts on Disney. It just tells you that they're opening the way for a rebound, not guaranteed though. They closed puts on Intel, booking profits on those. Huge whack for Intel this week. Almost about 30 of its value. Then closing puts on the NASDAQ, on Snowflake, on Moderna. They're closing calls though on the SLV Silver, on Eli Lilly. Maybe Eli Lilly is going to turn around to negative again. They're closing calls on Meta. So Meta doesn't look good here despite the big gain for the week because they're buying puts and they're closing calls. Something is happening in Meta here. We'll talk about this in a minute. But they're closing calls on Taiwan, on Apple, on Microsoft. Now let's segue to the unusual trades. We got EA, Electronic Arts. We got the earnings from Take-Two. They're okay, but any implications on EA? Perhaps. Somebody knows something here. And they bought the 150 calls, expiration date September 20, spending about $1.6 million. I got another one here for you for USO. This is for a bet on commodities on oil. So they're betting that oil will go higher. And they bought the 80 calls, two different expiration dates though. You got one for this week, 8/16, you got one for next week, 8/21. Spending about $500,000. Again, a bet on perhaps higher inflation data, a bet on perhaps we see a flare-up in the geopolitics in the Middle East. Not a bad bet for now. Then we have a chart that we've been talking about throughout the week as a bullish chart. Maybe got a little too excessive for the week though. So the entry is important if you want to follow this. But somebody bought the 190 calls, expiration date September 20, spending a little over $500,000 on those. So LNG Cheniere, with the comeback of the Henry Hub natural gas commodities, it could add up to more gains in this stock. But it needs to break above the recent resistance line. If you grab a chart of LNG, you will see that we have sort of a triple top. You need to pass that as a confirmation that yes, the stock is breaking out. Then we have calls in the VIX, which is bullish for the VIX, but bearish for the equities market. Somebody bought the 30 calls, expiration date this week, 8/21. So they're betting that the VIX will be above 30 by the end of the week, spending about $2.25 million. It tells me that we will see a resumption of volatility going higher and the equities market going down. Here we have another one, VIX long calls. Somebody bought the 25 calls and they sold the 40 for the expiration date this upcoming Friday, August 21st, spending about $1.5 million. This trade says that we'll be above 25, not sure about 30, but even if it happens, I'm covered because I only sold the 40 calls. I don't think that the VIX will be above 40, but will certainly be above 25, if not above 30. That's what the trade says. So we have confirmation, at least from the traders here, that the VIX is going higher, equities market going down. Let's look at the bearish trades. AMD, somebody's buying a high conviction bearish trade, by the way. And the reason is they sold the 160 calls for the expiration date of October 18th, and they bought the 130 puts, same expiration date, spending about $350,000. Now, if they bought the naked puts, we would have said, okay, bearish. But what makes it a high conviction bearish trade? The fact that they sold the 160. It tells us one or two things. Either the trader with the short combo really confident that AMD is going to go down way below 130, and this is why they want to reduce the entry cost by selling a upside call and raise cash from it. Or it could be somebody who owns AMD, and they sold the covered calls at 160, and they bought the 130 insurance policy in the puts. Either way doesn't show great confidence in AMD going higher. Then we have another semiconductor play on the bearish side. On semiconductor, the ticker ON. Somebody bought the 65 puts, expiration date September 20, spending about $400,000. So we see bearish bets against chips fading the rip. Now here's the most interesting trade on Friday's session. Highly unusual, massive trade. Somebody bought puts on Meta. The 485 puts, the expiration date September 27, spending about $9 million. What did they see here? Because the earnings were good. The stock was the outperformer for the week. Gotta be insider information. Gotta be somebody who knows something is coming, and they're buying these puts. It just doesn't make sense to buy naked puts like this with $9 million worth of exposure without prior knowledge. We'll see what happens. Let's move on to the charts, folks. But I want to begin with the story of the SPX, how the chart developed, because it is important for us to follow the development step by step. You're looking right now at the daily chart of the SPX, the cash index for the S&P 500, the most important chart. I'm highlighting for you the violation in the lower Bollinger Bands. So Monday, not a good entry for shorts. Good entry to book profits from shorts, and good point to speculate on a rebound, even if it is a short-term rebound. Just to go within the Bollinger Bands again, maybe close the gap, maybe a retracement of a certain moving average. Because in the past, if we zoom out of this chart here, every time we got a violation of the lower Bollinger Bands, we've seen a rebound, and in certain cases, that was actually the bottom of the market. I don't think it's the bottom of the market and higher we go. But again, it says that on that day, when we've seen the violation of the lower Bollinger Bands, that was a point to close the shorts, place some rebounds, and wait for further feedback. Not to jump in and open new puts with overpaying on them and then expect that you're going to make money. Amateur mistake. Zooming in the chart again, what do we see here? Let's retrace what happened at the top. We got the topping head and shoulder pattern. We talked about many indicators pointing out to that outcome, be it actual technical indicators or even sentiment/anecdotal indicators such as the stripper/hooker indicator. When the chatter becomes in the strip club, is it good time to buy the S&P 500? Get the hell out. If the strippers are buying, you're selling. And by the way, don't use that as an excuse to go to the strip club just to do economic research. It ain't gonna work with your wife. I'm just giving you a piece of advice here. Anyhow, we got the topping head and shoulder. We began flirting with the trend line, and then we got the confirmation, which is a huge rejection candle from the 20 days moving average. Now we know that we got a confirmation of the topping head and shoulder, and down we go. And since then, if we zoom out of the chart, We look at the other indicators like the MACD, the RSI. Were we oversold at that point? The answer is no, so we can anticipate more selling to come. Then Friday, we've seen a huge gap down. At that point, I said, look, without knowing what's going to happen on Monday with the yen trade, that even at that point, the risk of a rebound was highly likely because we're going to get to a point where we're oversold. Comes Monday, we get even more oversold, and we have a bigger violation of the lower Bollinger Bands. It becomes so obvious that it's a trap and higher we go on a rebound. Okay, we got a rebound, now what? Zooming in the chart again, we don't need the indicators. We got a retracement to the 100 days moving average in red. Got a rejection Tuesday, but we did not have a reversal candle. We gave another shot Wednesday to the 100 days moving average, and that time we got a bearish confirmation that the 100 days moving average is a no-go. So that was a bearish engulfing candle. And a lot of folks bought puts based on that. Can't blame you, but it was a trap by the market maker because the next day they gave you the jobless data and the algos pushed the tape higher, retesting the 100, closing above the 100. Now understand that red candle that we got on Wednesday's session trapped both the bears and the bulls. The bears bought, maybe still in contracts, maybe it's going to work out next week or after that, who knows, if the market goes down. But certainly folks who bought the rebound got scared and got out of these trades, only for the market to move higher and close above the 100 days moving average by the end of the week. What do we do now? If you're looking to the upside, you got closing the gap because we have a confirmation right now, bullish confirmation above the 100. You got to give it the benefit of the doubt. What is the next target? We'll be closing the gap, and that's in or around 5,364.55. If we close above that number, then the next target becomes the 50 days moving average. And by the way, that coincides with the 20 days moving average too. Now we see the 20 crossing below the 50, which is not a good sign for the S&P, but it's a really solid target for resistance if we pass the gap, say this week. What do we have to look for on the other side of the trade, the short side? We need to see a failure at the 100 days moving average, rejection at the gap, failure at the 100 days moving average, loss of the 100 days moving average, closing below. And that would be a confirmation that, okay, the rebound is done. We're going to resume the move to the downside. And then the target becomes obvious. You got the point where we got a rebound Wednesday, the low of the candle, then you got the low from Monday. But at that point, you got to look at the weekly chart. So we look at the SPX weekly chart. Where do we find solid support in the weekly chart? The answer is the lower Bollinger Bands, so in or around 5,000. I think that's going to be the inevitable destination before we find some solid footing in the weekly. The problem is it could be just a rebound. I'm speculating now that it could be a rebound but continuation of the end of the wave as you see in the MACD, the end of the bullish wave in the MACD, where it goes down, crossing below negative and confirming the end of the bullish wave that began since 2022. And if that is the case, sure, we're going to go down to 5,000, find some support, rebound, then cut below 5,000 and decline even more. And that will be topping head and shoulder, not just in the daily, but the weekly too. Again, we're getting ahead of ourselves here, but I need to give you the outlook of what happened, what to look for, and how it can influence the longer-term chart. With that out of the way, let's do the hourly chart for the SPY. I'm showing you a trend line in the chart. We've broken the trend line Wednesday. Look at the MACD indicator, who's about to cross from producing green impressions in histogram into red impressions as a confirmation of a shift from bullish to bearish. But then came the rescue by the jobless data. And we got a rebound back within the trend line, back within green candles on the hourly histogram. What do we do from this point on? We go to the SPY daily chart. What do we see here? The gap is sitting at about 533. If we close above the gap, again, we will go with the retracement to the 50 days moving average, perhaps the 20. But if we fail at this point and we turn around and we close below the 100 days moving average, which is sitting right now at 529.80, you can see that line in red. If we take that out, the likely outcome would be whatever rescue, whatever rebound we got this week. It's within a larger bear flag pattern, and we're going to break to the downside again. If we break to the downside, then what is the target? The obvious would be, of course, the lows from Monday. What comes after that? The 200 days moving average in yellow. Then you got to remember that Bank of America warns that if the S&P takes the 200 days moving average as support, it'll be a confirmation for a hard landing in the economy, one step at a time. The Q's hourly chart, same thing. Broken the trend Wednesday. We were going to head down, revisit the lows from Monday. Then came the rescue, as you can see in the MACD indicator, from the jobless claims data. Okay, we're now at the gap. What do we do from here? Some folks would argue that maybe we have a rising wedge pattern I heard that on Discord. It's not really a rising wedge. Rising wedge comes when the chart is trading higher. In fact, this is a bear flag pattern if we zoom out to the daily chart. So we're now trading above the gap, but we still have the 100 days moving average in red. We haven't crossed above that as we did in the SPY. So any rollover from here will be confirmation of the bear flag on the hourly chart, or we can look at it from another perspective here, an inverse ABC pattern. And the confirmation for more pain to come would be crossing below the 200 days moving average in yellow. On the other hand, crossing and closing above the 100 days moving average in red would be a bullish confirmation. So right now the Qs is not out of the woods by any means. Looking at the hourly chart for the NASDAQ futures, consolidating within range, got the whack Monday. Came the reflex reaction of buying the dip off a double bottom. Okay, it held on, no buyers showed up. So Wednesday we got a flush down, but we caught support at 17,735.75. After that, the jobless claims data were back to the same range, maybe the upper range of the consolidation throughout the week. Closing the gap, but we cannot speculate more than that. Looking at the NDX, the weekly chart for the NASDAQ 100. The trend is broken, so that's done, but we're back within the first Fibonacci retracement line. We closed above. If we lose it again, and you have the other indicators of the SPY losing the 100 days moving average, for example, if they're all aligning together, the Japanese yen is coming back up, the VIX is heading back to 30, bond yields coming back down, the dollar coming back down. If we lose the Fib support in the weekly in the NASDAQ, then you put 2 and 2 together, and it means it was a false rebound and the index is heading back down. Looking at the IWM, the Russell 2000 small caps, the weakest of the bunch because it is within the bearish engulfing candle, the body of the bearish engulfing candle from Wednesday. It couldn't beat it. And right now the odds, absent of something magical happening this week, the odds right now still for an inverse ABC pattern, and we're probably going to break 200 and trade in the 190s again. What about the dollar index? Got a rejection of the 20 days moving average and we flushed down. The Japanese yen rallies, the dollar goes down, recession news come out, now we're hammering the dollar even more. But again, Tuesday, Wednesday, Thursday, Friday, we got a rebound. A little bit of a rebound doesn't change anything, but it helps the algos to buy equities. Are we out of the woods in the dollar? Not really. What I see right now is perhaps an inverse ABC pattern in the making. The inflation data will have an impact on the dollar up or down. And right now, the market fears dollar going down, not dollar going up. That could change if we have a hotter than expected inflation rating. Then the dollar is going to go up, and we go back to the market fearing the dollar going up and perhaps also fearing the market going down because of recession risk. And this is why I say if we get hotter than expected inflation data this week, forget about it, game over. The market loses whether the market goes up or down. But you know what doesn't lose? It's the old man gold. Steady Eddie here, all of the volatility, didn't lose a lot of ground, so this is why gold is a safe haven, is the real safe haven. Not Bitcoin, not the other bullshit that you people buy. And I know what the concern is. Somebody's going to grab the monthly chart of gold and say, Maverick, are you really going to buy gold at these levels right here, these readings in the RSI? First of all, we've been saying you got to buy gold way before that happened, but even right now, you can speculate and say it's not a good entry for gold, and you're going to be proven right at some point, because when the market crashes and we see the rush to the safety, the ultimate safety that is, of the dollar and bonds, then gold will suffer too. But let me take you back to the financial crisis of 2008. Monthly chart again. You can see, yes, every time we violated the upper Bollinger Bands, we went down, but not by a lot. And the rally in 2007, 2008, we got to the upper Bollinger Bands, but we kept rallying and getting overbought in gold. So maybe you still got a lot of juice to squeeze here in gold. And even after the crash took place, sure, gold went down, but recovered really fast after that and made higher highs. And this is why gold is a higher quality asset. And it's even more superior than silver. Look at the ratio between GLD gold and silver, SLV. Every time the chart is rallying higher, gold is outperforming silver. And you can see that every time if you're worried about a crisis, and you want to hedge, gold is way better than silver. I know silver has its supporters and the bros love it and all of that, but the data doesn't lie. Gold is a better quality asset than silver. And during times of volatility, during times of fear, gold outperforms silver. We keep the same ratio in blue, gold versus silver, plug in the S&P 500 in orange. And again, you see, every time we have a market downturn, gold tends to outperform silver. So when we look at the chart of the SLV, it is underperforming gold by a lot. It's actually trading at the lows right now. So the way I do it, I'm long gold. I use the SLV silver to hedge. So if there's a rise in the dollar that's going to hammer gold, I'm buying puts in the SLV because the SLV will go down and those gains will compensate me for the loss in my gold holding. I use SLV silver as a hedging mechanism, and that's about it. Looking at crude oil daily chart, what do we see here? Got a rebound, double bottom perhaps, but we're not out of the woods in crude here. We need to close above the 20 days moving average. We need a confirmation in the MACD where you see green impressions being printed in the histogram for the daily MACD, that is. But here's the take, folks. Clean up the chart. We're still looking at crude oil in the candlestick patterns, but we plugged in ExxonMobil. In white, we plugged in XLE, the energy ETF, in blue, and we plugged in the OIH, the energy services ETF, in yellow. The message is clear, folks. We go back since the fourth quarter of last year. ExxonMobil is the outperformer. Then comes crude. Then comes the ETF. Then comes oil services actually negative. Why? Because the services are more cyclical. If you have any recession fears, they're impacted more and earlier. Now, Exxon enjoys the best cash positioning in the energy names. It is actually showing profits while Chevron's showing loss. It has good valuation and it pays a good dividend. So when we have a rush to the safety of dividend-paying stocks, Exxon is picked up too, even though energy commodities are trending down because of recession fear. So for now, the highest quality asset in energy happens to be Exxon. Looking at the 10-year yield daily chart, what do we see here? We got the rebound Tuesday. It's starting Monday, to be honest with you. Monday, we got buying the dip outside of the lower Bollinger Bands. Buying the dip in yields, by the way, meaning booking profits in bonds. So we see the rebound Monday, Tuesday, Wednesday, Thursday, and the market goes higher with it. Then Friday, we see a stall, perhaps a bearish engulfing candle. If we see yields going down Monday, Tuesday into the CPI, ain't going to be good for equities. After the CPI, we'll see if good news is still good news, or are we back to good news being bad news. The risk right now for the 10-year yield is an inverse ABC pattern, and if the algos are reacting the same way, it'll probably be bad for the equities market. Now look at the XHB yield-sensitive home builders. These guys, just like the IWM, lose either way because bond yields going higher for them, not good, because mortgage rates go higher. And bond yields going down for the wrong reasons, the recessionary reasons, obviously not good for the home builders. So they lose either way. The IYR real estate, on the other hand, still has high-quality assets within it that pay a nice, generous dividend. So when we have any rotation into dividend-paying stocks, because yields are going down, these names pick up steam and they push the index higher. But real estate is not a good sector to be in. We have the risk of commercial real estate. We have the risk of offices in multifamily units being under distress. So if you want to short real estate, you short these individual names. The IYR will go down, that's inevitable. But so long as we have the allure of dividend-paying stocks still going on, you will see that the largest weighted kind of stocks in the IYR are the high dividend-paying names. And those are higher quality than the commercial real estate. And those will go higher, lifting the ETF higher, while we see the offices, the multifamily unit, the medical properties all going down. So if you're going to short anything in real estate, you got to pick individual names, not the ETF. What about regional banks, the KRE? It's the same dilemma with the XHB home builders and the IWM small caps. You lose if bond yields go higher, and you lose if bond yields go down for the wrong reasons, aka recession. So right now it's stuck, and I think we head lower, absent of any good news, where we see yields going higher because of good news, or yields going down because of good news. Really hard to see right now. The VIX, let's follow the journey here. In the daily chart, we talked about the consolidation pattern that will produce a pop out of the VIX. Indeed, we got it. And then after that, we talked about an ABC breakout. We got the ABC breakout. Then we talked about an ABC within an ABC. We got yet another ABC breakout in the VIX. Did it get too excessive though? And the answer is yes. You look at the weekly chart. We talked about buying the VIX when it closes above the 20 weeks moving average. And that was the right call. But we said we sell the VIX if it goes in a divergence outside of the weekly upper Bollinger Bands. And if it's extreme, the more likely it's going to fade. And indeed it did fade. I don't think we're done though. I think there is another pop higher. We're recocking the gun right now for another shoot higher in the VIX. We're just cooling things off. And then higher we go. You look at Apple, Big Kahuna, what do we see here? On the daily chart, we got a violation of the lower Bollinger Bands. That's going to give you a rebound, no doubt about it, even though we got the topping head and shoulder formation. Can we close the gap, let's say 220, or even retest the 20 days moving average, then come down? That's what I'm looking for. And my leading indicator right now would be the 50 days moving average in blue. We're trading above, so right now the upside has better odds than the downside. If we lose and close below the 50 days moving average, then I would say, okay, it is time to pick up some puts on Apple and ride the momentum to the downside. But we gotta lose the 50 first, and it could be in sort of an inverse ABC pattern. And if that is the case, indeed will be comfortably below 200. If you don't feel like you want to speculate in the short run for Apple, you look at the weekly chart. Again, we got the topping head and shoulder formation, but the confirmation here would be the neckline, which coincides with the 20 weeks moving average. So closing below the 20 weeks moving average will give us a short signal on the weekly chart for Apple. And in this case, we have a huge gap all the way down to the lower Bollinger Bands. So you don't need to be in a rush here if you want to short Apple. The souffle Tesla, right off the gate. Look at the 100 days moving average in red, that's support. Look at the 200 days moving average in yellow, that's your resistance. We have no break one way or the other. Once we have a break, aka close below, we can follow the chart up or down. Right now, there's nothing for me to do here in Tesla. What about Nvidia though? Unlike the SPY and the SPX, it did not close above the 100 days moving average. So Nvidia is relatively weak. Does that say one way or the other you buy or you short here? Here's what I got to say. Zoom into the hourly chart for Nvidia. We're about to break down. We lost 100, closed below 100 on Wednesday's session. Then came the rescue by the jobless claims. We went higher again, but the risk of a topping head and shoulder in the hourly chart for Nvidia not eliminated yet. It will be once we close above 106.30. That will be a bullish confirmation to me. But if we roll over and we take 100 again as support, that will be a bearish confirmation for me to short all the way till the 200 days moving average in Nvidia. Lastly, tulips. Bitcoin, what do we see here? We are now facing resistance at the 200 days moving average in yellow. Forming, give it the benefit of the doubt right now, because it is forming a bull flag pattern. It could make it. Now the chart is going to develop overnight, so by the time the video is out, you're probably going to see it developing already. If we get a rejection, if there's no bull flag, then oh boy, it could be painful here for Bitcoin. Or we might head down because it could be a confirmation of a topping head and shoulder in the daily. And then furthermore, you look at the weekly chart. Sure, we got a rebound off the lower weekly Bollinger Bands. That's always going to happen. But we are now within the body of the Bollinger Bands. And we have a confirmation of lower highs based on the sloping line of resistance that we got. So now we have lower highs, lower lows. If we stall here and head down again, then we have lower lows to come. So crypto bulls, you gotta close above the 200 days moving average. With that, folks, let's move on to the conclusion of this video. What do we have on the economic calendar this week? Comes Monday. We don't have a lot. We have the federal budget, not gonna be important. But then we have Tuesday, August 13th. We have the Small Business Optimism Index on top of the Producer Price Index. And that's going to be a leading indicator to inflation. Wednesday, the most important day, the 14th. The CPI day, baby. It's going to be fireworks. We'll see what happens, but it is the most important day of the week. But hold your horses here, folks, and buckle up your seatbelts because Thursday, the 15th, will be also eventful with a lot of macro data from initial jobless claims, the Empire and the Philly Fed manufacturing surveys. Retail sales, really important. Couldn't be more important than retail sales on Thursday. The Import Price Index, the industrial production, capacity utilization, finishing with business inventories. And lastly, Friday the 16th, consumer sentiment from the University of Michigan, really important. Housing starts, building permits, home builders confidence index, really important data for the housing market. On the earnings calendar, the health of retail from Walmart, Home Depot, all important indicators for the economy. Then we have Cisco, we have Alibaba, we have a chip name from AMAT, Applied Materials, we have a cybersecurity name in Palo Alto, Deere, the health of the global economy, Ross Stores, the health of the lower income consumer. Eventful week, folks, to say the least. You haven't seen anything yet. This week was interesting, but it was only interesting Monday. After that, the action cooled off. But the action is about to resume this week in a big way. So buckle up your seatbelts, but we're gonna be here, covering it day by day. But for now, gotta take a rest here. It's a long show. If you enjoyed it, please return the favor by pressing the like button, subscribing to the channel, leaving us a nice comment in the conversation below, and better yet, join us as a member to access the daily videos and more bonus videos. But with that, folks, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
You gotta have two things to win. You gotta have brains and you gotta have balls. And you got too much of one and not enough of the other.